Thanks for joining David, Kevin, Alex, and myself for the educational video and a little bit of a market update. There are so many things going on. We're now in the third week of the US-Iran conflict. There's tons of things going on in the market. I know you've got a lot of questions, so I'm going to pass you over to the guys and they're going to fill in some of the blanks and let you know what's going on. As always, if you have any questions, want to review anything, please don't hesitate to give any of us a call. Take care and hope you and the family are doing well.
As Harry mentioned, we also wanted to talk a bit about what's going on in the markets and more specifically how that is being affected by the conflict between Iran and the United States. Now, with everything that's going on, there's a lot of uncertainty in the markets, and the markets don't just react to what is happening, they tend to react more to what could happen. And because there is no really ending in sight with the conflict that's happening, we're seeing a lot of what could happen next possibilities increase, and that's why we're seeing so much volatility in the market.
Now, the most immediate economic impact shows up in oil. And this is where the Strait of Hormuz comes into play. You might have been seeing a lot of headlines about the Strait of Hormuz over the last couple of weeks, as it's become a major part of this conflict. Now, the Strait of Hormuz is a narrow waterway in the Middle East, located right between Iran and the UAE. And it's roughly where about 20% of the global oil supply flows every day. This means that even the risk of a disruption to this waterway can push oil prices meaningfully higher, and that's what we've been seeing play out since the conflict started. Since the conflict began, oil prices have not only gone up, but they've also become much more volatile on a day-to-day basis, as markets are still continuing to price in that probability of further supply chain disruptions. Now, why does oil matter so much to the economy? Oil is a key input across everything in the global economy, from transportation and shipping to manufacturing to supply chains and everything in between. So when oil prices rise or oil prices are less certain going forward, it increases the cost for doing business globally. Those higher costs often get passed down to the consumer. And this is where you'll see things like higher prices at the pump, which you may have noticed recently, higher shipping costs, and ultimately higher costs of everyday goods and services. So that's how oil ends up feeding into the overall inflation in the economy and why it has such a big impact on the markets in general and consumer confidence. That being said, today, energy represents a much smaller portion of the consumer share of consumer spending, than it has in previous years and previous decades. So while it's important, it's not necessarily enough to trigger a recession on its own unless that supply shock is meaningful and carries on for a long period of time.
Now, this is not the first conflict that we've seen in recent history, and it's not the first conflict that we've seen with a tie to oil. Not too long ago, the US invaded Venezuela, essentially, captured their leader, and created a lot of disruption to their oil market. Now, what we're seeing here is that not all conflicts are equal. Iran is a major regional power with very meaningful oil production and military capabilities. What that means for the current conflict is that the array of different potential outcomes is much larger, and that means that there is a higher probability that this conflict has a much more prolonged effect to the conflict itself and then to markets as well.
From a market perspective, the key issue now is how is this conflict going to play into inflation and growth going forwards? If oil prices do remain elevated like we've seen, this is going to lead to inflation potentially staying higher for longer, and that could put central banks in a potentially difficult position. Later on in this video, we'll touch on the Bank of Canada's rate decision that happened today and what that ends up meaning for the markets. Central banks now have the decision: do they continue focusing on inflation like they have been over the last couple of years, or do they start shifting towards supporting more economic growth? If growth does begin to weaken due to this conflict, we could see a more accommodative policy response, even in an environment where inflation hasn't necessarily been normalized down to their target range.
Now, despite the seriousness of the current situation, the broader economic cycle hasn't fundamentally changed. We're still in a mid-cycle expansion, and the risk of a recession is still relatively low. Now, historically speaking, we need to see a much larger shock and a much more prolonged shock to the system, more particularly to the energy markets, before we see any fundamental change in that outlook.
And another important thing to note is that markets are still being driven by the fundamentals. So corporate earnings still remain strong globally, and that strength is becoming more broad-based. We're not just seeing strong earnings in large cap stocks anymore, but we're also seeing good participation in value stocks, small caps, and other areas of the market which have lagged behind in the past. This is generally an overall healthy sign for the markets.
So what does all of this mean for you, the investor? In the short term, it does mean that we're likely going to experience some more short-term volatility, but with that volatility comes opportunity. We're already seeing many fund managers utilizing cash that they've held and deploying that into other areas of the market. Maybe stepping away from stronger US equities that they've held for long periods of time in the past, getting away from the Mag 7, and finding different opportunities in Canada, in Europe, or in the Asian Pacific markets, which is also creating much better diversified portfolios, which we always like to see.
Now, like I mentioned earlier in the video, one other thing that we've been paying close attention to is the Bank of Canada's rate decision. So the Bank of Canada met today and they decided to keep the overnight policy rate at 2.25%, marking the third consecutive hold in a row. Now, this decision by the Bank of Canada reflects a cautious wait-and-see type approach. They don't want to make any rash decisions based on the conflict that we're seeing today. They'd rather wait and see how this is going to have a longer-term effect on the markets before they make any decisions.
Central banks, not just the Bank of Canada, are really in a tight balancing act at the moment. In one hand, you do have energy prices increasing, which can cause inflation. And in the other hand, you have a lot of geopolitical uncertainty in the markets, which is creating downward pressure on economic growth. It was really nice to see the Bank of Canada hold rates where they were, and as Alex said, maintain that wait-and-see approach while they wait to see how this conflict plays out in the short term.
So if there's one thing that Kevin and I would like you to take away from this video today, it's to remain focused on the long-term opportunities rather than the short-term volatility. Over these next couple of weeks, you're going to see a lot of headlines in the news that are designed to invoke an emotional response from you. And while we do recognize that they are real and they can be scary, it's important to stay focused on your long-term goals and the long-term opportunities that may stem from a conflict like this.
But as always, if you do have any questions or you just want to reach out and chat with us about what's going on, feel free to reach out to Harry, David, Alex, or myself anytime.